The state pension is going up in April 2026. That much is true. The triple lock has delivered a 4.1% increase, and millions of pensioners across the United Kingdom are set to receive more money every week than they did in the previous financial year. On the surface, that sounds like good news, and in many cases, it genuinely is good news. But there is a reality beneath that headline that the government is not volunteering, and that is making pensioners across the country genuinely angry when they discover it. For a significant number of pensioners, the increase in the state pension is not delivering the financial improvement they expected, because the tax system is quietly taking a portion of that increase back. And for some pensioners, it is taking back more than they ever anticipated. Welcome to DWP Truth. This channel exists to give you the honest and complete picture of what is happening to your retirement income, not the headline, the whole story. Stay with me, because what I am about to explain affects hundreds of thousands of pensioners right now, and the number is growing every year. Let us start with the fundamental tension that is driving this anger. The triple lock commits the government to increasing the state pension every year. It is a promise that has broad political support and that has delivered real increases in pension income over many years. But running alongside the triple lock is a completely separate government policy that works in the opposite direction for many pensioners. The income tax personal allowance has been frozen at $12,570 since 2021, and the government has confirmed it will remain frozen until at least 2028. These two policies are on a collision course. Every year, the triple lock pushes the state pension higher. Every year, the frozen personal allowance stays exactly where it is, and the gap between the two is closing fast. Here are the numbers that every pensioner needs to see clearly. The full new state pension for 2026 to 2027 is $230.25 per week. Multiply that by 52 weeks, and the annual state pension is $11,273. The personal allowance is $12,570. The gap between your state pension and the point at which income tax begins is now just $597 per year. That is $11.48 per week, less than the cost of a weekly shop for one person. At the current rate of triple lock, increases that gap will close entirely within 1 to 2 years. And when it does, pensioners receiving only the full new state pension with no other income will, for the first time in history, begin paying income tax on their state pension. But here is the reality that is already hitting hundreds of thousands of pensioners right now. You do not need to receive only the state pension for this to affect you. If you receive any additional income on top of your state pension, the combination may already be pushing you into tax liability or pushing you deeper into it than you were last year. Think about what additional income might look like for a typical pensioner: a workplace pension from a previous employer, an annuity purchased with pension savings, rental income from a property, savings interest which has risen significantly in recent years as interest rates increased, part-time earnings from consultancy or casual work. Any one of these sources, combined with the increased state pension, can create a total income that crosses the personal allowance threshold. And here's the part that makes people genuinely angry. The tax on income above the personal allowance is collected in a way that many pensioners find deeply uncomfortable. For most pensioners, HMRC adjusts the tax code applied to their workplace pension to collect the tax owed on the combined income. This means the provider of your workplace pension deducts more tax from your occupational pension payment to account for the fact that your state pension is already using up your personal allowance. The result is that your state pension payment appears to arrive untouched and looking exactly as it should at the new higher rate, but your workplace pension payment has shrunk because it is carrying the entire tax burden for your combined income. For pensioners who do not understand why this is happening, it can feel like their workplace pension has been arbitrarily reduced at exactly the moment when their state pension increased. The overall effect on take-home income is that the triple lock increase is partially, or in some cases, almost entirely absorbed by higher tax deductions elsewhere. How much tax are we actually talking about? Let us use a concrete example. Imagine a pensioner receiving the full new state pension of $11,173 per year and a workplace pension of $4,000 per year. Their total income is $15,973. The personal allowance is $12,570. The taxable income is $3,403. At the basic rate of 20%, the tax owed is $680.60 per year. That is $56.72 per month being deducted from their workplace pension. Now compare that to what they paid in tax last year. In 2025 to 2026, their state pension was $11,502 per year. Combined with the same $4,000 workplace pension, their total income was $15,502. Their taxable income was $2,132. Their annual tax bill was $586.40. Monthly deduction $48.87. The triple lock gave this pensioner an additional $471 per year in state pension, but their tax bill increased by $94.20 per year. The net benefit of the triple lock increase after tax is $376.80 per year rather than $471 more. The tax system has taken back approximately 20% of the increase. For pensioners with higher additional income, the proportional impact is similar, but the absolute numbers are larger. This is not illegal. This is not a mistake. This is the mathematical consequence of two government policies operating simultaneously in opposite directions. The triple lock increasing pension income every year. The frozen personal allowance holding the tax threshold static. Every year, the two policies interact to deliver a triple lock increase of which an increasing proportion flows to HMRC rather than to the pensioner. What can you do about this situation? There are 3 practical steps that every pensioner affected by this should take. The first step is to check your tax code. Your tax code determines how much income tax is deducted from your workplace pension or other employment income. The most common tax code for a basic rate taxpayer is 1257RL, which reflects the $12,570 personal allowance. If your state pension is now consuming most or all of your personal allowance, your tax code on your workplace pension will be adjusted downward to reflect this. Check that the tax code shown on your workplace pension payslip is correct. If you believe it is wrong, contact HMRC on 0300 200 3300 or use your personal tax account at gov.uk to review and query your tax code. The second step is to understand whether your savings interest is pushing you over the threshold. In the current interest rate environment, many pensioners are earning significantly more interest on their savings than they did 3 or 4 years ago. This interest counts as taxable income. If your state pension plus any workplace pension plus your savings interest exceeds $12,570, you are liable for tax on the excess. Many pensioners are not aware that savings interest is taxable or are not including it in their mental calculation of their total income. Check your bank and savings account statements and calculate the total interest you received in the last tax year. The third step is to seek advice if you are uncertain about your tax position. Citizens Advice Bureau offers free guidance on tax and benefits. HMRC's own helpline can answer questions about your specific tax code and liability. And Tax Help for Older People is a charity that provides free professional tax advice specifically to pensioners on lower incomes. Here at DWP Truth, we are not here to alarm you unnecessarily. The triple lock increase is real, and for the majority of pensioners, the net benefit after any additional tax is still a genuine improvement in income. But you deserve to understand the full picture. You deserve to know why your workplace pension payment might look smaller even as your state pension has increased. And you deserve to plan for the reality that this interaction between the triple lock and the frozen personal allowance will intensify every year until the allowance is unfrozen or until the state pension itself crosses the threshold entirely. The anger that pensioners are feeling about this situation is legitimate. It is the anger of people who were told their pension was going up and who then discovered that the tax system was quietly waiting to collect a share of that increase. Knowing about it in advance does not make it less frustrating, but it does make it manageable. If this video helped you, hit the like button right now and share it with every pensioner you know who needs to understand what is really happening to their income in April 2026. Leave a comment and tell me whether your tax code has already been adjusted this year and how it has affected your take-home income. I read every comment and respond regularly. And if you are not yet subscribed to DWP Truth, subscribe now and turn on the notification bell. Because in the coming days, we are covering exactly how to check your tax code, how to claim back overpaid tax, and every step you can take to keep as much of your pension increase as possible. See you in the next video.